Hello, John, and I believe Laura joined. We're going to give it until just after 1 o'clock and let people sort of come in dribs and drabs, and then I'll sort of kick things. Hello, everyone, and welcome to all of you that have joined. Just going to leave it a few more minutes. Make sure that everybody can get on. So it'll probably be a couple of minutes' time that I'll kick things off. Thank you. Still got people joining, guys. I'm just going to let that run its course for a minute, and then we'll kick off. So thank you to those of you that have just joined. We're just going to give it another minute or two. There's still people joining, so I'll leave it till about 3 or 4 minutes past, and then we'll start. So look, it's 3 minutes past. I'll kick off. If anybody else joins, you'll have to just forgive me while I admit them and stop. So welcome to everybody to Maximising Business Success. My name is Andy Southgate and I'm the Senior Chartered Financial Planner for Drewberry. So I have 20 years experience in the wealth management profession, including 8 years spent in the Iberian Peninsula, advising high net worth and ultra high net worth individuals, families and trusts. Now Drewberry is a company that's based in both London and Brighton. However, as we do the vast majority of our work virtually, we have clients all over the UK, including as far as the north of Scotland. So we've got a variety of specialisms, including corporate work and insurance. I, however, work for the wealth planning side of the business, and today we're going to be talking specifically about issues that business owners face when looking to plan financially. So what we'll cover today, there's an agenda on the screen for you now. We'll talk about cash extraction and give you a summary of that. We'll then talk about some tax efficient ways of extracting cash from your business. We'll run through pensions a little bit and particularly touch on workplace pension schemes. We'll then look at enterprise investment schemes and venture capital trusts and the tax relief methods associated with them. Finally, we'll move on to insurance and talk about business protection, specifically focusing on key person insurance. And then finally, how as a Drewberry are able to help you. And then we'll move on to a Q&A. And on the bottom right, you'll notice that there's, if you don't use Google Meets regularly, on the bottom right, you'll see there's an icon with a triangle, a square, and a circle there. If you click on that at the end and click on Q&A, we can do the Q&A on there and hopefully answer any questions you may have. So cash extraction then, as many people here are probably already aware, there are three main routes for a business owner to extract profits from their limited company, which are on the screen now. So their salary, dividends and pension contributions, as well as the tax rates as well. So the key determination on this is that the net benefit to the owner in terms of how they structure their payments, whilst nobody likes making payments in tax or national insurance, hang on, I've just got some people joining, ladies and gents, so bear with me. Whilst nobody likes making payments in tax and national insurance, if you could do this in a way that gives you the most benefit, why would you not? Paying tax is not necessarily a bad thing if the end result is more money in your pocket at the time that you need it. So salary, as we know, is taxed as per any employee. Sorry, I've still got people joining, guys, so apologies for the breaks. So salary is taxed as per any employee, and you'll have a personal allowance, which is £12,570 per annum. Now, remember, there is a reduction for those with an adjusted net income of over £100,000, and in certain circumstances, your personal allowance will reduce to zero, giving you an effective tax rate of 60% on that money earned. Dividends, most people know this as well if you run a business. So dividends are simply payments from a company profits to shareholders. There's a nil rate of taxation applied to the first £1,000 per annum, and thereafter dividends are taxed as per on the screen at the moment. I'm going to gloss over that because I'm pretty sure most business owners will understand it. So how can you get the profits out of your business in the most tax efficient manner? The simple answer to this is to make pension contributions. As detailed above, these do not suffer corporation tax or national insurance when these are made from the business, and when the benefits are taken, 25% is usually tax-free and thereafter taxed at marginal rates with no national insurance whatsoever to pay. However, those under the age of 55 need an accessible source of income for living expenses today. So we need to look at how a business owner or a potential client can extract money from their business to meet day-to-day living costs now and in the future. So the table on the screen now shows a basic comparison between the three remuneration methods, that's salary, dividend, and pension contributions for the current tax year. And we've based it on £1,000 of income that falls wholly within the relevant taxation band. And by the relevant taxation band, I mean either 20, 40, 45%. As you can see, the pension contributions, if you look at the column where it says per £1,000 of business profit in your pocket and just kind of ignore the rest of the columns for now, you will see that the pension contribution results in you receiving the highest net return in all examples, okay? So it's essentially a no-brainer if you've got the means to do it to fund a pension scheme. So why put the money away then for future use if you're happy paying dividend tax today? So some business owners would rather take their money out as a dividend today and have this in their current account so they have total control of the money. Presumably, they often believe that they don't really control their pensions, which is incorrect, but nevertheless, it's a view that I've come across quite a few times. But if we take the following example of how this would work for the current tax year, would they still have the same opinion? So let's meet Bill, who has a business and is taking profits from this in the form of dividends. He's a high rate taxpayer and he's taking £1,000 net more per month than he needs to put in his bank account. So if Bill could be convinced to give up £500 a month of this and put it into a pension, then his situation would be greatly improved. So let's work through this example. £500 a month equates to £6,000 per annum. And grossing this back up with a higher rate of dividend taxation applied, that's 33.75%, means that the business needed to pay £9,056.60 gross for this to go to Bill. From here on in, I'm not going to talk about the pence, okay? I'll just use whole numbers. But the above dividend payments that I'm talking about can only be made after the business has paid corporation tax. So the total profit from the business needed to provide this dividend becomes £12,075 if the business is paying the main 25% rate of corporation tax. So paying this £12,075 from the business to a pension would avoid immediate taxation, which is corporation tax and dividend tax in this case. Now, the Centre for Policy Studies research has said that 6 from 7 higher rate taxpayers are not then higher rate taxpayers when they reach retirement. So presuming that Bill becomes a basic rate taxpayer in retirement, this would give him £10,264. So if we were to ask him if he's willing to give up £6,000 per annum in his current account that he presently doesn't actually need, and instead have £10,264 in his bank account when he retires, what is he going to say? You can't really say that we'll invest that money to get a better overall return because the same investments are available in a pension scheme. So let's look at some of the risks to having your business as a pension. So many people see their business as a pension, which is very understandable. But having your business as your pension has got quite a few downsides. Firstly, it's available to creditors. It may not be sellable at the right time, and you may find that ill health prevents you from running the business. When I look at all the clients that I've looked after in my 21-year career, how many of them had all their retirement funds riding on one investment in one single private equity? The answer to this is you probably just figured out is none. So why defy conventional logic? Having a pension and a business to fund your retirement helps you to diversify risk. It helps to make your retirement choices more flexible with far more options than just having a business only. So just to conclude then on this section, as can be seen, there are a limited amount of options for extracting money from your business. Each of these has their own particular tax and national insurance consequence for a business owner with their employer and employee hats on, as it were. So whilst this can be technically complex, the planning is actually quite simple. You just extract the minimum amount of profit required to fill your current account for today for your immediate needs, and the rest can go into your pension to maximize your current account for the future. So it's very simple planning. So we'll just cover quickly off some of the pension rules. So there's something called the annual allowance, and this has changed several times since it was introduced in 2006, and it's £60,000 currently. There's also something called carry forward, which allows you to make use of any annual allowance that you might not have used during the 3 previous tax years. Sorry, someone just wants to join the call, so I'll just let them in. So as I was saying, carry forward allows you to make use of any annual allowance that you might not have used during the 3 previous tax years, provided that you were a member of a registered pension scheme during the relevant time period. In effect, this gives you the ability to make more contributions than the £60,000 annual allowance if you have allowances available from those 3 previous tax years. And we do this for people all the time, so please do contact us if it's something you feel you would benefit from. There's also some significant advantages around inheritance tax with pension schemes, so let's just cover off what inheritance tax is. It's a tax on the estate of someone who has died, including all property, possessions, and money. The standard inheritance tax rate is 40%, and it's charged on the part of your estate that's above the tax-free threshold, which is currently £325,000. Inheritance tax usually doesn't apply when you pass on your pension money, and this is because, unlike your investments, your pension isn't part of your taxable estate. That's why it's tax efficient to keep your savings in a pension fund and pass it down to future generations if you can afford to do that. The money in your pension isn't covered by your will. You'll have to tell your provider who you wish to be considered as your beneficiaries. They'll take this into account when deciding who to pay your pension savings to. When you place money into a pension, it's immediately outside your estate. However, because of the relatively low amount, and I stress the word relatively here, that you can place into a pension being set at 60,000 each year, older people may not have enough time left to fully mitigate inheritance tax. However, there are plenty of other options available. So moving away from that and going on to something that's usually pretty important for anyone who's an employer, and that is workplace pension schemes, and some of the reasons to look at the workplace pension schemes that you might be providing for your employees. Firstly, compliance with legal obligations. So there are automatic enrollment schemes, and they are governed by specific legal requirements such as pension contribution levels and eligibility criteria. Regularly reviewing the scheme helps ensure that the employer remains compliant with the latest legislation and regulations, and this is crucial to avoid penalties or legal consequences later on down the line. There's also changing workforce demographics, so workforces evolve over time with employees and joining and leaving the organization and demographics shifting. Reviewing the automatic enrollment scheme allows employers to assess whether the current default contribution rates and eligibility criteria still align with the needs and expectations of their workforce. Adapting the scheme accordingly helps to attract and retain talent. It's also valuable for employers to compare their automatic enrollment scheme with industry standards and best practices. Reviewing the scheme provides an opportunity to benchmark against similar organizations and ensure that the pension provisions remain competitive. This can help the employer stay attractive to prospective employees and meet employee expectations. Let's look at financial sustainability. Automatic enrollment schemes involve financial commitments from both employers and employees, and regular reviews allow employers to assess the financial sustainability of the scheme and make adjustments if necessary. This ensures that the contributions and investment options provided are reasonable and aligned with the organization's financial capabilities. There's also employee engagement and satisfaction, so regularly reviewing the scheme demonstrates a commitment to the employee's financial well-being. It provides an opportunity to gather feedback from employees, understand their needs and preferences, and make improvements accordingly. And finally, there's the evolution of the pensions landscape. So the pensions landscape and associated regulations may change over time, and governments may introduce new incentives, alter contribution requirements, or modify tax regulations, and they do that all the time. Employers should review their automatic enrollment schemes to stay abreast of these changes and ensure compliance. So overall, regular review of these schemes helps employers fulfill their legal obligations, aligns the scheme with the evolving needs of their workforce, allows them to remain competitive, and demonstrate a commitment to employee well-being. As part of this, maybe you've considered salary exchange and maybe not. But let's just cover off what it is. You may have heard of it. It's sometimes referred to as salary sacrifice, but you may not necessarily be familiar with what it is. But put simply, in this agreement between you and your employees, where they agree to exchange part of their gross salary, bonus, or even redundancy package in exchange for a pension contribution. It works in the same way as other salary-related benefit schemes, for example, a company car, cycle to work, and childcare voucher schemes. Salary exchange is a simple, tax-efficient way for you to save money on your workplace pension scheme and improve the benefits package you offer your employees. The main advantage is both you and your employees pay less national insurance contributions, and employees would pay less income tax. You can then choose how to reinvest those savings. So you can keep some or all of those savings to reinvest back into your business, or pass some or all on to your employees by adding it to their pension contribution. You could also decide if your employees' savings will be reinvested in their pension or their take-home pay, for example. Whichever option you choose, there is no increased pension contribution cost to your business. So how do you set this up? Well, if you're concerned that setting up a salary exchange arrangement could be complicated, rest assured it's a relatively straightforward process. You can offer the arrangement to some or all of your employees, so long as their reduced salary doesn't fall below the minimum wage. They'll just need to agree to an altered contract of employment, which can be done through an agreement letter or an opt-out option. And Drewberry are able to advise you on your options with salary exchange and assist with the implementation of the arrangement. So moving away from pensions now, let's look at some alternative options. So once you've taken money out of your business, as we've seen, there are limited options for extracting that tax efficiently. But what can you then do later on when you've got money, for example, in your current account? So let's look at two things: venture capital trusts and the enterprise investment scheme. These are government-backed initiatives offering tax reliefs to investors who buy shares in qualifying companies, and the tax reliefs are on the screen now. So this kind of investing is for people who want to hold shares in small companies with the potential to grow many times their current value. They're comfortable in taking on the risks of backing early stage businesses and staying invested for the long run. It's likely, and we would recommend, that you've already maximised your ISA and pension contributions before looking at this, and that you want to benefit from tax relief. They have high growth potential. An EIS investment, for example, can give investors access to companies they may not otherwise hold and which have the potential to multiply in value. You'd also be supporting UK businesses. Investing in an EIS or VCT helps innovative, smaller companies to create jobs, prosperity, and economic growth across the UK. So let's look more specifically at the tax reliefs associated with EISs first of all. Investors can claim up to 30% income tax relief on EIS investments, which gives an incentive for some of the risk normally associated with funding small companies. The maximum investment is 1 million, which amounts to £300,000 of income tax relief. Investors can get the relief in the tax year that the money is invested into a company, and that might be different to the year the investment is actually made because of the time taken to get the money in. Investors in approved EIS funds can choose also to treat an investment as if it was made in the previous tax year, which can be very useful for tax planning. It also means that up to 2 million could be invested in a tax year, that is 1 million in the current tax year and 1 million carried back to the previous tax year. As an investor, you have to hold the shares for at least 3 years, and the company must remain EIS qualifying for that 3-year period. If not, you'd have to pay the tax relief back to HMRC. Income tax relief has got to be set against the income tax bill for a particular year, but it can only reduce your income tax bill to 0 or to nil. In other words, you cannot get into credit with HMRC. There's also tax-free growth. So when you sell the shares, any growth in value from them is 100% tax-free, which is worth noting because small, early-stage companies have the potential to grow significantly. There's also even more incentive by investing in something called knowledge-intensive companies, or KICs, and these offer added flexibility in terms of the maximum amount that can be invested. So that would actually increase to 2 million per tax year, provided at least 1 million of that is invested in a KIC. Again, you can carry that back to a previous tax year, so you could, in fact, invest 4 million in total. That's 2 million for the current tax year and 2 million for the previous tax year, as long at least 1 million in each year was in that KIC. There's also capital gains deferral. So if you've made capital gain on the sale of other assets, that can be reinvested into EIS shares and then deferred over the life of the EIS investment. And there's no upper limit on the value of gains that can be deferred. It's important to note that it's the gain rather than the proceeds of the sale that should be reinvested. For example, if an asset was sold for £50,000 and cost 10,000, that would result clearly in a gain of 40,000, and it's the 40,000 that needs to be reinvested in order to qualify. There's also inheritance tax relief. So if you were to hold the EIS shares for at least 2 years, you can pass them on when you pass away, completely free of inheritance tax. And finally, there's loss relief. So because EIS investments involve buying shares in early stage companies, the risk of these shares dropping in value is higher than most other investments. Loss relief reduces the impact of the losses made on individual companies. And this is the case even if an investor holds a portfolio of many different EIS companies that overall has delivered a positive return. Let's move on then to venture capital trusts. And just say what they are first of all. So venture capital trusts are investment companies that are listed on the London Stock Exchange and set up to invest in small UK businesses that meet certain criteria. Again, to encourage support for these businesses, the government offers generous tax benefits for VCT investing. So what do they invest in? Well, typically they will invest in small early phase businesses that are either unquoted or listed on the alternative market, which is the London Stock Exchange market for growth companies. These businesses need investment in order to develop. They can potentially give you a high return, but they can also be much riskier than larger, more established companies, as their shares can be illiquid and hard to sell. Also, you must remain invested for at least 5 years to keep the tax credit, so VCT shares are also longer-term investments. So because of these factors, they should only form a small or limited part of your overall investment portfolio. So let's run through the tax reliefs on them then. Well, again, you have the income tax credit at 30%, but it's only on investments up to £200,000, whereas EISs, as I've covered off, can be a million or up to even 4 million in certain circumstances. Tax-free dividends, there's no income tax to pay whatsoever on dividends from VCT shares. And we've got some clients here at Drewberry that are invested in VCTs that pay around 5% dividend every year. And they get that completely tax-free. So imagine a scenario if you have, let's say, the full 200,000 in a VCT and you're collecting a 5% dividend every year. That's a nice £10,000 tax-free in your bank account. No capital gains tax. You won't be liable to capital gains tax whatsoever when you sell your VCT shares. There's also a variety of strategies to be found on the VCT market. They all invest in smaller companies and give you tax relief, but they are very different in their approaches to managing risk and reward. So you need advice before thinking of investing. Okay, moving away from investing completely then and into the area of business protection, and I'll just cover off a couple of different areas here. So there's something called key person insurance, which pays out a sum of money to a business to cover the loss of a key person should someone within a business pass away or suffer a critical illness. There's also business loan insurance, which does the same thing, but pays off corporate debt should a key person die or suffer a critical illness. And finally, there's shareholder protection, and that provides money to buy out the family of a deceased shareholder. It also prevents the dilution of business control and shares from being sold to the wrong parties. So I can give you an example of that. Imagine somebody passes away, a company director with a large shareholding, and then those shares pass, for example, to their spouse or children, who then want to get involved in a company that they know nothing about. So you want to be avoiding that, obviously, as a company director. So let's talk a little bit more about key person insurance. At the heart of every successful business, obviously there are talented, dedicated, and capable people, but none of us know what the future is going to bring. And research by Legal in General found that 59% of businesses believe they would have to stop trading in less than a year after the death or critical illness of a key individual. Therefore, a key person insurance policy helps safeguard a company against the financial impact of death, terminal illness, or a critical illness. Policy proceeds are paid directly to the business to help replace the key person and cover any profit loss. Those policy proceeds could help your business to continue trading. So who can take this out then? Well, if you own a business, for example, if you're a limited company director, you can take out key person insurance with the agreement of the person who's being covered. You'll have to have a financial relationship with that person. There's no right or wrong time to take out key man or woman life insurance policies. A startup company, for example, might be dependent on one or two individuals who are fundamental to the business's success, whereas a larger company may have greater resources and the ability to substitute key staff with other personnel. Having said that, established companies have larger overheads. If the loss of one individual affects revenue, the consequences for the business could be serious. Every business is different, but key employee insurance can provide a safety net for your business. So as you can see from the slide on the screen here, some statistical research done by Legal & General reveals that 94% of businesses recognize they have at least one key person, which makes me wonder a little bit about the other 6%. However, 75% of businesses have some form of business debt, and 6 in 10 businesses say they would cease trading within 12 months of losing a key person. From the same research, there are also some stats on the top 3 business risks as identified by business owners themselves. 52% said the death of an owner, 38% a major contract loss, and 35% the owner suffering a critical illness. So whilst you cannot insure against a contract loss, you are able to insure against a critical illness or the death of a business owner. The research furthermore showed that 46% of companies simply didn't see the need to have any kind of business protection. 17% were not advised to take out business protection, which is quite worrying. And 15% did intend to get the protection, but never got around to it.